Welcome, welcome, welcome back to From Middle Class to Millions. I am really excited about today's episode because it kind of was born from the webinar that I did last week. And first of all, let me tell you about the webinar because it was really, really good. We had a really good turnout. A lot of people showed up. A lot of people registered, which was amazing. A lot of people showed up live, which was great. And I was on for almost 2 hours. The webinar was scheduled for an hour, but people showed up with their questions, which again only reinforces what I already know, that people want to talk about money. People want to know if what they're doing with their money is correct, how they can get out of debt, how they can build wealth. They know that they're making good money, but they're not able to get ahead. They can't quite figure it out. They want to know if they'll have enough for retirement. Some folks want to know how to even get started. Will they have enough to have a full life today as well as in the future? People have questions. People have a lot of questions. And even though a lot of these folks have been talking to financial advisors, have been reading books, have been listening to podcasts, have been on social media, Googling stuff too, they still don't have the answers. And I think being in the room with me, whether it was a virtual room on Zoom, it gave them the opportunity to ask questions about their personal situations. Now, of course, there's only so much I could tell you in the few minutes that I have with your particular circumstance. And so obviously, when I work with folks, I get to know their whole picture. It is personal finance, right? We're talking about what works best for you, what your circumstance is, and the best options that are available to you. And so that level of specificity is given when we work together. However, there are questions that people ask that are pretty common across the board that a lot of people benefited from hearing the other people ask these questions. So a lot of folks said to me, hey, I wasn't able to attend. Is there going to be a replay? And ordinarily, I always record everything and I send out a replay. But because these questions were so specific, so personal, I don't feel comfortable sending them out to the whole world for everybody to hear everybody's personal business. Even though their names weren't revealed or anything like that, I'm not comfortable with that. So what I've decided, since there were so many folks who couldn't attend, I'm going to run this webinar a couple more times. And I'm going to do them at different times so that I could account for different time zones. I can also accommodate people in other countries. There were folks from Europe who asked me, hey, 7 p.m. Eastern time is like, 1 o'clock in the morning my time in Switzerland or what have you. So can you do a different time that maybe I could participate in? So I'm thinking about probably by the end of this month, and I'll let you know when I'm going to do the episode again, but the webinar again, but I'll probably do it at the end of this month. I'll probably do something around noon Eastern, maybe something around 7 o'clock again Eastern PM for people who are working. But I know that people tend to be home between Christmas and New Year's, and that might be a good time to run the webinar again so people can participate. Now, the content of the webinar was great. The content, I got a lot of positive feedback about it. Folks are really want to go into 2026 with some confidence and with the answers, right? And so the content of the webinar, how you can build $1 million net worth and become financially independent at any age, really hit home. Because I think what's holding a lot of people back, I know what's holding a lot of people back is that they think that they're too old, it's too late, they've wasted too much time. And so the worst thing that they do is that they just stay exactly where they are and they don't make any moves, any forward motion, and they don't do anything, which is in essence a self-fulfilling prophecy because they actually are wasting time, right? But I know that wealth building isn't determined by your age, right? And that is a lot of what you see when you are opening accounts, when you go to a financial advisor, that the first thing they say to you is, okay, how old are you? When do you want to retire, right? And it's all predicated around your age. And I debunked that entirely, which gave people a lot of hope, because I know I didn't start my wealth building journey, at 18 or 22, immediately out of university or anything like that. And I believe that people feel that if they don't do it right away, that all hope is lost. And I want to be clear that nothing could be further from the truth, right? All hope is not lost until you're in the ground, to be honest. So, of course, I would encourage everybody to start young. I would encourage everybody to start immediately. But if you haven't started and you think that all is lost, no. Every little bit counts, and you start your journey. And as you start your journey, the wealth will begin to grow. And you can hit those milestones if you have a clear strategy and approach to achieving financial independence. All right. So lots of questions came out of that webinar, which I think were beneficial. But the one question that, in speaking to a lot of folks over the years and during the webinar, was, okay, no, but seriously, how do you actually start? Like, what button do you click on the website to start investing? Now, what's funny about this is, first of all, I want to walk you through the whole process. And I have my notes because I went through it myself from the very beginning. I do this with people all the time, but I've never taken notes because I just know, click here, click this. This is why you're answering this, da 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 da. And I actually went through and did the whole process. So that I could have these notes here for you so that you could stop, you can pause, you can listen to this as you're going through the process and you're opening the account. But what I also want to point out is I've talked to women and men who've had accounts for years, and they themselves don't know which buttons to click. Okay, because they're working with an advisor and they're like, well, what if I wanted to go in and buy something myself, right? What if I wanted to invest in a stock outside of my financial advisor? And they don't know what to do. So yes, they have somebody managing their portfolio, but they don't even know how to go into their own portfolio and buy their own shares, buy their own stocks. And I think that is, what's the word? I guess it's a little disabling for them, and it's definitely not empowering. Because if you have the wherewithal to start investing and you've decided to work with someone to help you do that, you also should be able to do some of this stuff on your own, particularly if you're interested in doing so. I want you to understand how the system works. I want you to understand how to buy your own shares and your own stocks. I want you to be able to know what to do inside your own portfolio and how it's performing. But that is all of that we're not going to cover today because the episode would be far too long. But I want to cover how to actually open a retirement account. And I'm going to give you some overall information. And then if you want to dive deeper, if you need some help in which one to select, if you want to talk about which one makes the most sense to you, then book a call with me. That's the best way for us to get on the phone because it is personalized to you. The information that I'm giving is personalized to you. Whereas here, this is just generic, how to open an account, the different types of accounts that are available to you, and the selection of which account, well, that's obviously personalized. Okay, so here's the thing. As you guys all know, I've talked about it a million times before, you are responsible for your own retirement. Yes, there will be Social Security, depending on, how old you are. Like my kids are Gen Zs. I don't know how much will be available to them. Maybe the whole thing as we know it now. Maybe it'll be a percentage of it. Who knows? But you will also have access to Social Security. But if you are like many of the Americans today, you may not have a pension. And even if you have a pension, the pension may not be enough to support the lifestyle that you have or that you want. So if we want to factor in Social Security, some of you may have a pension. You also have to be responsible for any retirement savings outside of those two things or in addition to those two things. And so what I'm going to cover today is by the end of the episode, you're going to know exactly how to open a retirement account, how you're going to fund it, how how you're going to choose the investments within it, and how you're going to set it on autopilot. And I'm going to use Fidelity as our example. Don't get caught up in you have to use Fidelity. You can go to Charles Schwab. You can go to Vanguard. It doesn't matter. I'm just using Fidelity as an example so you can follow along. The steps are completely very, very similar at the other brokerage houses, okay? So don't get caught up in which one should I choose. Really, that's not the crux of the matter. It's start it, open it, let's fund it, and let's automate it. That's really what I want you to pay attention to. Okay, so first things first. There are different types of retirement accounts out there, and I think this is what causes some confusion. There are employer-sponsored plans, okay? These aren't always available. So just because you work for someone, just because you're a W-2 employee, it doesn't necessarily mean that they offer you an employer-sponsored plan, okay? It's just like any other benefit. Your employer can totally determine whether or not they want to offer these plans to their employees. But if you do have an employer-sponsored plan, you've probably heard of it before, like a 401k, maybe a 403b, or a 457 plan, or a TSP, which is the thrift savings plan. So these, because they are offered by your employer, you can't just go and open one on your own. You have to be employed by a company that offers this specific type of plan that you have the option to enroll in. Again, not all employers offer them. And if they do, you will have the option to enroll in them. So the 401ks, this is the most common one. You guys have probably heard about this. This is usually offered by private companies or for-profit businesses. Okay, so if you work for a corporation or a startup or even a small business, this is probably what they offered. I worked for a large pharmaceutical company. They offered 401ks. A 403b is another type of employer-sponsored plan. It's the same thing as the 401k, but it's for employees of nonprofit organizations or schools or hospitals or religious organizations. Teachers often have 403b plans, maybe, and a pension, for example. And a 457 plan, this one is for the state and local government employees. So if you work for your city or your county or your state government, you may have access to a 457 plan. And if you work for the federal government, which I have a lot of clients that are in that, DMV area that work for the federal government, they often have a TSP, which is a thrift savings plan. Also the military. See what I mean? That is another type of employer-sponsored plans. Now, the cool thing about these, what makes these so great is oftentimes when you work for one of these companies, they offer a match. So a match is you can contribute a certain amount of money and they incentivize you to do that by the company contributing a certain amount of money as well. People regard this as free money, right? Like this, you don't have to put in anything in addition to what the minimum requirement is in order to get the match. So if your company, for example, says, hey, if you put in 3%, we will match you 3%. And if you put in 6%, we will match up the additional 3%, maybe half of that, like half of what you put in, right? So there are different permutations on how they contribute the match, what the match looks like for your particular company. But overall, this is money that's free. And over a specific period of time, even if you leave the company, you may be eligible to take some or all of that money with you. It'll always be yours. And that's part of what's called a vesting schedule. So it depends on whether or not you're vested and the degrees of vesting. That determines how much of that money you can take with you if you were to leave the company. Okay? So if your employer doesn't offer one of these plans, you can't get one. All right. And that's what a lot of people don't understand. You can't walk into a Fidelity and say, oh, I want a 401k. No, a Fidelity can't offer you a 401k. A 401k has to be offered to you through your benefits from your employer. Okay. So what if you work for one of these companies and they're like, yeah, we don't offer a 401k. Well, you still have to take care of your retirement. Like you can't just be out here willy-nilly. You're still going to have to figure something out. So what is available to you is what is called an IRA. Now, an IRA stands for Individual Retirement Arrangement, okay? That is what the IRS calls it. But we tend to call it an individual retirement account. Fine. Don't get caught up in that either. You want to get an IRA. And the key word in there really is individual, because you can open this on your own. It doesn't matter if you have a 401k or not, because you can have a 401k and an IRA, but you have to open the IRA on your own. If you don't have a 401k that's offered to you by your employer, then you can still run out and get an IRA, because you're like, hey, I need to take care of my retirement. So you can go to a brokerage firm like Fidelity or Vanguard or Schwab, whatever, whomever, and you can open one up. All right. And that's what we're going to walk through today, because I don't want this to be for the folks that have 401ks only. I want anybody, because anyone, whether you have a 401k available to you, whether you're investing in the 401k or not, I want you to know that you can walk over to one of these brokerage firms and open up an IRA. So there are two main types of IRAs. And this is where people get a little confused, because as soon as they're like, oh my God, I have to make one of these choices, this is where they kind of stop. So there's the traditional IRA and the Roth IRA. And I'm going to explain both to you. Now, if the reason why I'm cramming all of this information in here is because I want you to be able to take notes. I want you to be able to pause this episode at any point. If you have any questions, I want you to write them down, and I want you to reach out to me if you do. This is the place where people tend to stop, and that's not what I want for you. I want you to actually get through this entire process. But if you have questions while you're doing this, you can reach out and book a call. It is important and it's quite imperative that you ask the questions. And again, I'm saying this because this is what I gleaned from the webinar. It's an opportunity for people to ask questions. Yes, you can book a call with me. We can talk about your particular circumstance. But if you don't even know, right, what to ask, being in the presence of other people who have similar questions, who want to talk about money, where you're being exposed to the language is very helpful. All right. So if you have any questions, please write them down and you can come back to me and ask. All right. So let's get back to the two main types of IRAs. There's the traditional IRA and the Roth IRA. So with the traditional IRA, what you're doing here is you're contributing money before you pay taxes on it. So let me give you an example. So say you make $50,000 a year and you contribute $5,000 to a traditional IRA, you're only going to pay taxes on $45,000 that year. Okay. So the benefit is you're getting a tax deduction now. So you're able to take that whole $5,000 and invest it in a traditional IRA, and your taxable income is reduced. So you don't have to pay taxes on the whole $50,000. It's a way to save on taxes, and you're only paying taxes on $45,000. And that $5,000 that you invest is able to grow in that traditional account tax-free, which is great. Like, it just keeps growing and growing and growing, and you're not paying taxes on it over the years. But there's a catch, right? Because the IRS always wants their money. When you retire and you start taking the money out, and there's an age limit where, you can't take the money out before you're 59 and a half. If you do, there are penalties, we can talk about that later. So imagine when you're putting this money in there, you're putting it in there until you're 59 and a half. But when you start to take it out, remember, you put it in, you didn't pay taxes on it, it was growing tax-free, it's lovely. When you take it out, you have to pay regular income tax on everything you withdraw. The idea here is the reason why you would select the traditional IRA is because you're thinking, okay, right now I'm in a higher tax bracket because I'm working and I'm making a lot of money. But when I'm in retirement, I'll be in a lower tax bracket so I can save money overall because I'm going to pay less taxes on that money when I'm 59 and a half and when I retire. Okay. The other IRA that's available to you is the Roth IRA. And it kind of works in the opposite way. You contribute money after you've already paid taxes on it. Okay. So there's no tax deduction right now. So if you make $50,000 and contribute $5,000 to a Roth IRA, Uncle Sam says, yeah, you still have to pay taxes on the full $50,000. Okay. Because you've already paid taxes on this money. Uncle Sam's like, I'm taxing you on the full 50. But this is the part that's huge. Your money also grows tax-free while it's in there, like the traditional IRA. But when you withdraw it in retirement, you don't pay taxes on it at all. None of it. Not on the money you contributed, not on the growth. All of it is yours tax-free at 59.5 when you start to withdraw it. And that's because you paid taxes on it up front. You see? So there's a benefit to both of these. And you have to decide, okay, this is a personal decision. This is where I help people. Which one do I choose? And there's a lot of criteria that goes into this. Now, I like to look at everybody's entire financial picture. What else is going on? What other retirement accounts may you or may not have? What is available to you? How much money will you need later? What will be your situation? What's your situation now? But when you look at this top line and you don't take the whole thing into consideration, usually there are two options that they give people. Well, you choose the traditional IRA if you want the tax break now and you think you'll be in a lower tax bracket when you retire. Or you choose a Roth IRA if you're pretty early in your career, you're in a relatively low tax bracket right now, and you expect to be making more money later. So you're basically paying taxes now at a lower rate, and then everything grows tax-free forever. Right? So they tend to help you make that decision based on your age and where you are financially, right? So I like to look at a more comprehensive approach, have a more comprehensive approach to how we make this decision, not solely on, do you think you're going to be making less money later or more money later and be in a lower tax bracket? Or do you think that you're not in a high tax bracket right now? There's more things that go into account, but those are top line if you want to make a decision right off the cuff to get started. All right. There are also income limits for the Roth IRAs. There are income limits for the 401ks as well, but we're not going to talk about that. There are income limits for the Roth IRAs. So if you make too much money, you can't contribute directly to a Roth. There are ways to get around that are legal, but I'm not going to bring that up now. So if you make too much money, and that depends on how you file. If you're single, if you're head of household, if you're married filing jointly, all of those things, there are limits. Once you hit those limits, you can't contribute to the Roth IRA directly. You're going to have to do a workaround, which we can talk about at another time. And there are also limits to how much you can contribute to the Roth IRA. So to either IRA, sorry. So you can contribute up to $7,000 for 2025. And if you're 50 or older, you can contribute $8,000. They give you a little extra $1,000 to catch up if you feel like you're behind. And they're like, here's the opportunity to put in $8,000. What I want to stress to you is, when I say that you can contribute up to the maximum of $7,000 or $8,000 if you're 50 or older, it doesn't mean you have to put in that amount of money. Start with whatever you have. If you can put in up to $7,000 for a year, great. Or $8,000 if you're 50 or older, amazing. If you can only put in $1,000 this year, get started. $500 this year, get started. I started with $25 a month, okay? And I did that for a while until I could increase the amount that I was contributing. So I don't want you to hear 7,000 or 8,000. I don't have all of it, and that's it. None of that all or nothing thinking. We don't want that, because that too will keep you out of the investment game. It'll keep you from building wealth. And what we're doing is learning so that we can continue to build wealth along the way and starting wherever we are. Remember, to invest, you only need $1. So don't let that $7,000 or $8,000 throw you off. You can start with whatever you have. All right, so we're going to open this IRA at Fidelity, and we're going to walk through the exact steps, okay? So, like I said, grab your laptop, be in front of the computer, get a pen and paper so you can take notes and ask questions, and feel free to pause this as you're going through the process and then come back as you are doing all of the steps, because I want you to make sure that you get all of these steps in here. All right. So you're going to go to fidelity.com, you open your browser, go in, you're going to go to open an account. And what's going to happen is they're going to ask you to choose your account type. And you'll see a bunch of different options. You're going to see a brokerage account option, retirement account, and IRA. You might see 529, which is college savings, and you'll see a whole bunch of other account options available to you. You want to click on the retirement account, IRA, or just IRA, right? However it shows up to you, okay? Now, Fidelity is going to ask you which type of IRA you want. So you're going to see traditional IRA, Roth IRA, and you're going to see a rollover IRA. And the rollover IRA, just for your information, this is for you if you're moving money from an old employer-sponsored 401k. Okay? We're not doing that. That's something I do with my clients when we're getting all their money together and they realize they have 401ks all over the place. Sometimes they choose to roll their 401k into a Fidelity, into a rollover IRA. Sometimes they choose to roll their 401k, if it's permitted, into their current employer's 401k plan, if that's permissible. So there are a lot of options here. But you're going to choose either traditional IRA or Roth IRA based on the criteria, right, that we talked about earlier. So in this example, let's say you're going to get a Roth IRA, right? So let's click on Roth IRA, and then you're going to click on Continue or Next, all right? Then Fidelity needs to know all of your personal information. So your full legal name, your date of birth, your social security number. They need to know your address, your phone number, your email address, employment information, like what do you do for work, all the standard stuff that they need to collect this information for tax purposes, right? And to comply with all the regulations. So you got to do all of that, fill it out, make sure it's accurate, and then just click continue. Then they're going to ask you a few questions about your investment experience and your goals. Now, I don't want you to stress about these too much. Just answer them honestly. It is not going to determine what is available to you. It's just the data collection for Fidelity behind the scenes. So they're going to want to know your investment experience. So are you beginner, intermediate, advanced? You decide. If you feel like a beginner, select beginner. Let's move on to the next question. Let's not get caught up. What are your investment goals? Is it retirement? Is it growth, etc.? It may be more than one. I don't know if it gives you the opportunity to select more than one. Again, don't worry about it. It's not going to impact what you get to invest in. And then they're going to ask you, what's your risk tolerance? Are you conservative? Are you moderate? Are you aggressive? Again, don't get caught up. Let's just answer these questions and move on. Then you're going to have an opportunity to review everything that you've entered. So double check that all your personal information is correct, especially your social security number and your address and your email, because that's how they're going to be communicating with you, right? There's some terms and conditions. Read them. I know they're long. I know most people don't, but please read through them and then check the box that says that you're going to agree to the terms, and then click submit or open an account. Okay. Once you've done that, your account is open. Now you have opened a Roth IRA, right? And you'll get a confirmation screen that'll show you your new account number. If you want, you can take a screenshot of it but you're going to get an email confirming that you opened the account with your account information. And now you officially have a Roth IRA. But this is the thing. There's nothing in it. It's empty, right? We don't have any money in it. Think of it as a suitcase. So we went out, we're going on a trip, and we bought a suitcase. All you have right now is the suitcase. You've opened up the suitcase. You have a Roth IRA. So we need to fund your account. We need to put clothes in the suitcase. So we need to put money into the Roth IRA. The Roth IRA. So having an empty Roth account is not going to do anything for you because we want to put money in it. We want money to grow. This is the whole point, right? So we need to link your bank account to your Fidelity account. Okay. So once you log into your Fidelity account, you're going to log in and they'll have you set up a username and a password if you haven't already. And once you're logged in, I want you to look for something that says accounts and trade or transfer. That'll be on the menu. Right? So once you click on transfer, Then I want you to select link a bank account or add bank account. Sometimes they change the language, but link a bank account or add bank account. And then they're going to take information like the name of your account, your bank name, your bank account number, and your bank routing number. So you can find this information on your app, or if you go to your bank's website, that information, not your account number, but your bank routing number is pretty generic. It's for everyone to see, but your bank account number and obviously the bank name you can fill in. Fidelity is then going to make 2 small deposits into your bank account. So something like they'll do like 2 deposits, like 15 cents or 20 cents. And really what they're trying to do is verify that it's really your account. This may take a day or two, but what it requires is that you go and look in your account. You see that, oh yeah, Fidelity made these 2 deposits. Once you see that, you got to go back to Fidelity and confirm the amounts. They're going to ask you, what were the actual amounts that we deposited? And it'll be the 15 cents or the 20 cents or whatever they do. Once you make that, you confirm what those 2 deposit amounts were, then your bank account is now linked to Fidelity. So great. So now your Fidelity Roth IRA and your bank account can speak to one another. All right. Now what you want to do is transfer money into your Roth IRA. Remember, we have this suitcase, but there's no clothes. There isn't any clothing in it. What are you going to be on your trip naked? No, we want to put money into the Roth IRA. We want to put clothes in the suitcase. So we're going to move money from our bank into the IRA. So I want you to go back to transfer and select transfer money. And you're going to choose from. So where are you transferring the money from? Well, the bank account that you just linked. And where are you transferring the money to? To your Roth IRA. And then it's going to ask you the amount. How much are you going to transfer? And that's whatever you're comfortable with, right? If you want to start off with $100, $500, whatever it is, it's entirely up to you. Remember, you can contribute up to that $7,000 if you're under 50, or up to $8,000 if you're 50 or above. You don't have to do it all at once, right? Like, you don't have to say like, oh my gosh, here's $7,000. Let me put it in there right now. You can start with small incremental amounts, okay? Once you make that transfer, you click submit and the money will be transferred from the linked bank account to Fidelity. This usually takes about 2 to 3 business days to show up in your Fidelity account. So you're going to have to go back again and look at your Fidelity account. You may notice it if you're looking at your checking account or wherever the linked bank account is. You may notice that the money was withdrawn, and then you go over to Fidelity and it's like, oh, this is magic. There's now money in my account. Great. So now we have an open IRA. We've transferred money into the IRA, but that's not it. That's not all. We've got something else to do, because when you transfer money, you transferred cash into your IRA. It's sitting in an account at Fidelity. That's a cash account. So you've transferred cash and now you've put it into a cash account at Fidelity. You haven't invested it yet. And this is a big mistake that I see people make all the time. They transfer the cash over to the Fidelity account, but they haven't invested the money. So you're just using another bank account. Fidelity's acting like another bank account. You're not making an investment, so the money hasn't been given the opportunity to grow. So I can't tell you how many people have had cash sitting in their IRAs thinking that they've invested, and it's been doing the same thing as your pathetic savings account because the money hasn't been invested. So we have to do the next step. All right. So we've moved the money over in cash and it's sitting in Fidelity. Now, this is also where people get confused because they're like, now what do I do? You're telling me to invest. How do I know what to invest in? What do I buy? What if I pick the wrong thing? We're going to make this really simple for you, okay? We are going to invest in a low-cost S&P 500 index fund, okay? Low-cost, broad-based S&P 500 index fund. What the hell does that mean? All right, this is what it means, okay? We're going to keep this really straightforward. And the reason why it's going to be really straightforward is because I want you to think about companies you already know. All right. The S&P 500 tracks the 500 largest publicly traded companies in the United States. So think about Apple and Microsoft and Tesla and Google and Amazon and, Berkshire Hathaway. Think about the biggest companies in the US. This fund buys all of those. It tracks the performance of all of those companies. So when you invest in the S&P 500 fund, you are buying a tiny piece of all 500 of these companies, right? And because of the biggest companies in the United States, you're basically betting on the growth of the American economy, okay? And historically, the S&P 500 has returned about 10% per year on average over the long term, right? Sometimes it's gangbusters. It's like 25%, 23%. Some years it's down 10%. But over time, it trends upwards. And on average, it has returned about 10%. So what's best about the S&P 500 index fund is that these funds are low cost, okay? They have very low fees, which are called expense ratios, because they're not actively managed by a group or an individual. They just track the index automatically. So we have that S&P 500, and the funds that we're going to invest in just track it. It just follows the S&P 500. What is it doing? We're going to do it. What is it? What's happening with it? We're going to follow it, right? So these funds are very inexpensive. Now, I'm going to give you an example of a fund that Fidelity has that tracks the S&P 500. It is called FXAIX. That's the ticker symbol. If you can Google that, FXAIX. You can Google it, and the full name of it is Fidelity 500 Index Fund. It tells you exactly what it is, right? It's like, hi, I'm Fidelity. I'm the index fund that tracks the S&P 500. The expense ratio, or the annual fee for this fund, is just 0.015%. So to give you an example, for every $10,000 you invest in this fund, you pay $1.50 per year in fees. That's incredibly low. It's incredibly low. And that's why it's one of Fidelity's popular funds, because it is so inexpensive, right? Sometimes the fees are 2%, 1.5% for different funds. So knowing that something is 0.015% just means it's incredibly low, and all your money isn't going towards fees, right? So how do we buy FXAIX? How do we actually click the button to invest? All right. You're going to log into your Fidelity account again. You're getting comfortable with this because we've been doing it all week, right? And you're going to make sure you're looking at your Roth IRA. Okay. Now, for some of you, that may be the only thing you have in there, so you wouldn't be looking at anything else. But you're going to look for a button that says trade or buy/sell in the top menu. Click on that button. You're going to be asked, what do you want to buy? So in the search box, you're going to type in FXAIX. You want to buy that index fund, and you're going to hit enter. Okay. And what's going to happen is the Fidelity 500 index fund is going to pop up, right? You're going to see it pop up, and you're going to click on it. Okay. Now you're going to be on a screen where you can place an order. Okay. And that basically means you're going to buy the fund. You're actually going to buy it. So you're going to make sure that the word buy is selected, right? You're not selling anything. You're buying it. So you make sure the word buy is selected, and then you're going to put in an amount. You can buy a dollar amount or a number of shares. I like to just say, let's pick a dollar amount, because it's too much to calculate how many shares you want. It's way simpler to just say how much money you're going to invest, right? So let's say you transferred earlier on this week $1,000, and let's just assume you're going to invest the whole $1,000. Remember, that $1,000 is just sitting in your Fidelity cash account. So now you're like, okay, I have $1,000 in my Fidelity cash account. I want to invest some money. Let's invest the whole $1,000, but you can invest how much ever you want, but we're here to invest. So let's go for it. So you're going to choose an order type, and the order type you're going to choose is market order. That means you're going to buy this fund at the current price. Don't overthink this. We're not going to make it complicated. You're just going to click market order, because you're buying it at the actual market price, right? This is where the financial industry, why order? Okay, but whatever, one at market price, but they like to confuse you. That's fine. Select market order. Then a screen's going to come up that allows you to review your order. It'll show you exactly how many shares you'll get. Don't worry about the exact number. It doesn't really matter because you're buying a certain dollar amount. You're spending a certain amount. You're going to click submit or place order, right? And that's it. You just invested in the stock market. Your money is now invested in an S&P 500 index fund, and it'll grow. Sometimes it'll shrink in the short term, but overall, along with the overall market, it is going to trend upwards as it has in the past. Okay? So you've invested. You went in and you did it manually. What I want you to do now is to automate your investments. And let me tell you why this is really important and magical. Because the single best thing you can do for yourself is when you automate your investing, you can set it and forget it for the most part, and nothing gets in the way of it, right? Nothing pops up that overrides and starts messing with your brain. And, you start to say, well, maybe I shouldn't invest in, well, maybe I should buy something instead. Or no, once you automate investing, you actually will forget that this money is being drawn out of your account, and you will continue to live your life, right, as your money is working for you in the background. All right? You're not trying to time the market. You're not trying to figure out when to buy. Should I buy on a Tuesday? How about right now it's down? You don't have to pay that much attention to the market in terms of what's going on, because what you're going to be doing is removing the emotion from the equation. You're not going to have to listen to somebody screaming on CNN or MSNBC about how badly the market's doing or how great it's doing, because you're going to just keep investing. Okay. You're not going to have to think, is it a good time? Should I wait? Should I put in more? No, you're just going to invest consistently. And this strategy is called dollar cost averaging. And it really is remarkable. And it's really like magic because it works beautifully. Because when the market's high, your money, that $1,000, will buy fewer shares. But when the market is low, that same $1,000 will buy you more shares. And over time, that all averages out. And you keep building wealth. And you don't have to worry about timing the market. So let's set up some automatic contributions, right? Again, we're going to log into good old Fidelity. You're getting accustomed to this now. But now you're going to go to Accounts and Trade, and you're going to click on Transfers. Okay? So you're going to look for an option that says either Automatic Transfers or Set Up Automatic Investment. And I want you to click on that. And then what you're going to do is you're going to set up the following. The transfers are going to come from your linked bank account, which we did earlier on. They're going to go to your Roth IRA, the suitcase that we set up, and you're going to set up an amount, like how much you want to transfer every single time. You guys know I used to do $12.50 every 2 weeks, which amounted to $25 a month, but you could do 50, 100, 200, 500. I don't know. You have to know what your current financial situation is. You have to know your budget. You have to know your cash flow, but you got to determine how much you want to transfer. And because you have that cap up to $7,000 a year or $8,000, if you're over 50, you can decide, if you want to take $7,000 and divide by 12 and start contributing that amount. It is entirely up to you. Now, you can also break it down by the frequency in which you want to make these transfers. You can do weekly. So let's say you get paid on Thursday and you want to do it every Friday after you get paid. If you might do bi-weekly because you get paid, every other week. So you might want to do it immediately after that. You may want to do it monthly on the 1st or the 15th of each month or whatever works for you. You want to pick the frequency, and then you want to select a start date when you want that very first transfer to take place. Now, here's the thing. You can set it up to automatically invest that money once it hits your IRA. So remember, when you're automatically transferring the money, it just goes into the suitcase. We've got to buy the funds. So you can make it such that when the money is transferred from your bank account into your IRA, it'll automatically buy FXAIX. It'll automatically buy that low-cost, broad-based index fund. You can set it up to do that. So look for an option like automatically invest transferred funds or auto invest in FXAIX. I think that's the best thing to do because now you don't have to go back in there and fiddle with it and do that whole option where you select buy and the market order and the price. Don't even bother with it. Let it go straight in and do its work so you don't even have to think about it. All right. But if Fidelity offers this option in that same workflow, you just put in FXAIX, right? The one that we talked about, and let it invest that full amount that you're transferring at a frequency every single time. If it doesn't offer that option in the same step, don't worry about it. You just need to set up a separate automatic investment. So you would go to accounts and trade, and then look for automatic investments. And from there, you put in FXAIX to automatically purchase with whatever money is sitting in cash in your IRA. So every time the money comes in from your bank account at that frequency that you chose, it's going to buy FXAIX with that money. So if you decide $500 the 15th of every month goes in there, then it's going to automatically buy FXAIX. And then you click submit and confirm, and away it goes. And now it's set up. So think about what this looks like in real life, right? You set up this $500 automatic transfer every 2 weeks from your bank account to your Roth IRA, and you set it to auto invest in FXAIX. And like clockwork, the money moves from your checking account to your Roth IRA or whatever linked bank account you have. The money immediately buys shares of FXAIX in the amount that you've determined. And you don't have to think about it. You don't have to remember it. It just happens. And over the year, that money just keeps accumulating, and that's more and more money that's invested, more and more growth. You see, that's how the serious wealth is built in the background while you're sleeping, when you're not even thinking about it because you're too busy out here living your life. So all you know is that, hey, I've got money invested there. It's growing for me. It's working for me. I don't need to think about it. I'm over here not worrying and perseverating about my retirement anymore because I'm contributing to it and I'm building wealth. And this is the pay yourself first type of mentality. Okay. So what I would recommend, if this money is coming out of your checking account, I would tie it to your paycheck. And whenever you get paid, within a day, get that money over to Fidelity. Have it automatically withdrawn. So if your paycheck hits on the 15th, get that money from your paycheck to Fidelity. Set up your transfers on the 16th. Don't even give yourself an opportunity to let something else jump in front of that money. Pay yourself first. That is how you invest. That's how you build wealth. You don't want to get distracted by anything else. Get that money over to Fidelity. Get it into your Roth IRA. Get it invested immediately so you don't even have to think twice about it. Nothing can get in the way of you building your wealth. So that's it. I mean, that's it. You've opened this Roth IRA now. You've funded it. You've invested in a low-cost S&P 500 index fund, and you set up automatic contributions. So you're an investor now. That's it. You are now on your path to building wealth and building up your retirement fund. Now, this is what you have to do next. Nothing. Seriously, nothing. Just let it sit there and let it grow. Let those contributions come in. Let those bank transfers occur. Let it buy the S&P 500 index fund, and don't even think about it. Don't check on it every day. Don't freak out when you hear some nonsense about the markets tanking. If it goes down 5% or 10% or 20%, all of that is normal. All of that has been happening for years. It goes up, it goes down, it goes up and goes down. You don't have to worry. That's what the market does. Okay. But over the long term, okay, because we're talking about our retirement fund, over the long term, the stock market has always trended upwards. There are going to be bad years. There are going to be bad decades. Sometimes it happens. But if you stay invested, stay the course, and keep contributing, you will build wealth. You will. And as you get access to more money, so if you get raises or bonuses, or you get better at managing your budget and your cash flow, and you may get a promotion or a new job, every single time, bump up your contributions. Go into Fidelity and change that number that you initially put in there and raise it, right? That's how you avoid lifestyle creep. And even if you raise it by $25 or $50 a month or whatever it is, that makes a huge difference over time because of compound growth. All right? Because of compound growth, those small incremental increases make a difference over time. So you don't need to freak out over your account. You don't need to be in there every single day. I think it's important to check on it maybe once a quarter or once every 6 months. Make sure all your automatic contributions are still going, still happening. Sometimes if you change accounts, like your checking account or you switch banks, you might forget that you had this, these contributions going over there. You just want to make sure everything's looking kosher, everything's good, and that your money's being invested and not just sitting in cash over at Fidelity. You don't want that to happen. You want to feel good about the progress you're making, right? So periodic check-ins are important, but you don't have to be in there every day perseverating over your investments. That's not the point of this. All right? All right. So that's it, guys. It's not that complicated. We just walked through the entire process of opening an IRA. You funded it, you chose the investments, and you automated the whole thing. So I did this, and I have actually, this is funny, on Instagram, I have a link that takes you through this process where I did a video of this as well. But this comes up all the time, that people don't know how to do this process. And this is why I want to take this time in this episode to go through it. And I know it's a little bit longer, but I want you to have this available to you. I don't want any excuses. I don't want to hear, I don't know how to start. I don't want to hear, I don't know which button to click. I put it out there for you because I want you to get started, because I want you to know exactly what to do, right? This is not financial advice for you. It's educational. And what we're missing is the literacy, the financial literacy. And although, yes, everyone's situation is different, but the mechanics of opening the account and starting to invest is the same. Okay? That's the same for everyone. And now you know how to do it. You know how to do it for yourself, right? So I get it. The hardest part is always starting. That's where you have to overcome that inertia. But once you take that initial step and you open the account and you make the first investment, it gets so much easier. This week alone, while you're going through setting up this account, you've been on Fidelity's website. I can't tell you how many times. You may have downloaded the app as well. You can now see what's going on with Fidelity. You've gone in and out there more than you have probably ever, right? If you didn't even have an account. But now you do, and you don't have to keep going back in there. But when you do go in there, right, you will start to see the impact of your contributions and your investments. And you'll understand, wow, this is acting very differently than when it's sitting in a bank account doing nothing, making nothing. And so in the future, when, you can retire comfortably and you're traveling or you're spending time with family and you're not stressed out about money, it's because you started today and opened that account today. And you're going to be grateful that you opened it today because there's going to be money accessible to you. So this is what, when they talk about your future you, it's going to be happy. It's going to be thankful. This is what they're talking about, right? Now, like I said at the beginning, if you want help choosing the right account, if you want help knowing what the right strategy is with your entire picture in mind, that's what I help people do. That's why you get on a call with me. That's why we work together. I have gotten women to millionaire status simply by learning how to invest in these various accounts. Okay? And choosing the right account for their situation, their financial situation today, not based on their age, based on their goals and where they're starting from at this very moment. That's why I highly recommend that you book a call. I'm putting the link in the show notes below, of course. Get on the phone with me. Let's talk about your circumstance. All right, folks, I know this was a long one, but I really wanted to make sure we went through all of the steps so that you actually, by the end of 2026, you've opened this account, or at least you know, in the very least, if you already have one of these accounts open, how you can increase your contribution amounts, how you can buy a share or buy stocks or buy equities, whatever it is, an index fund on your own by yourself. Okay? All right. If this episode was helpful at all, I want you to share it with someone. Anyone who's been saying they want to start investing, they just don't know how to start, they don't know where to begin. I think we can all help each other build wealth and financial security by sharing information. It is important for us to become financially literate. This is what I talked about in the webinar. This is what I talk about every single day on social media. This is what I want to impart upon all of the women that I want to get to millionaire status. I've got 10 already. I have many more that are on their way to becoming millionaires. My goal is to get 1,000 women to $1 million so we can all have $1 billion collectively. I don't believe $1 billion needs to be in the hands of one individual, but if we spread it across 1,000 women, that's great. That is my goal. All right, folks, share this episode. Please book a call. If you're confused, you can't be any longer, but if you have questions about what I talked about today, bring them to me. I would love to hear from you. All right, you take care, and I will see you next week.